So today we are going to discuss about the basic accounting concept, techniques, and convention. So first, learning objective. This is a learning objective. Read and interpret the basic financial statements. So that's the first thing we should know. To read and to interpret the basic financial statement. So the need for accounting. So what's the need for the accounting? Managers, investors, and other internal groups want to answer two important questions. So what are those questions? First, how well did the organization perform? And then, where does the organization stand? So that's the question to be answered. And we can answer that by the use of accounting. So accountant answer these questions with two major financial statements. So first, income statement and balance sheet. So income statement answer the question, how well did the organization perform? And then where does the organization stand, answered by the balance sheet. The next, business transactions. So what are transactions? A transaction is any event that affects the financial position of an organization and requires recording. So it needs to be recorded. Transaction must be recorded, and it must be recorded chronologically. And now, balance sheet. So this is the one financial statement, balance sheet. The balance sheet, it is also known as the statement of financial position or statement of financial condition. It is a snapshot of the financial status of an organization at a point in time. Next, asset equals equities. Assets. So assets are economic resources that are expected to benefit future activities of the organization. Then equities. Equities are the claims against or interest in the assets of the organization. Next. So, balance sheet equation. So, what is the balance sheet equation? The balance sheet equation is assets equals liabilities plus owner's equity. So, this is the accounting equation. And it's the heart and soul of accounting. So, what are liabilities? Liabilities are the entity's economic obligations to non-owners. And then owner's equity, it is the excess of the assets over its liabilities. The owner's equity of a corporation is called stockholders' equity. So, if the business is a corporation, stockholders' equity is being used. While if it is sole proprietorship, it's owner's equity. And then balance sheet accounts. So, stockholders' equity composes of two: the paid-in capital and the retained earnings. Accounts receivable. So what are accounts receivable? Accounts receivable are the amounts due from customer from sales on open accounts. Accounts payable are the amount owed to vendors for purchases on open account. So next, learning objectives. Our learning objective is to analyze typical business transaction. So here now we are going to analyze the transactions that affects the business. So we will analyze it through the use of balance sheet equation. So King Hardware transactions. So King Hardware Corporation or company has the following transactions. First, initial investment by the owners, $100,000 cash. The next, acquisition of inventory for $75,000 cash. Then acquisition of inventory for $35,000 on open account. Next, merchandise costing $100,000 was sold on open account for $120,000. So these are the accounting equations. As we see, asset equals liability plus stockholders' equity. So here, we can see that the first transactions involve cash, which is $100,000. Okay? Initial investment by the owner, we can see 100,000 cash. Asset will go up by 100,000 and stockholders' equity do the same. Next, acquisition of inventory for 75,000 cash. So here we acquired inventory for cash. So our cash will be deducted by 75,000 and our inventory will go up by 75,000. Then next, acquisition of the inventory for 35,000 on open account. So number 3, the inventory will go up by 35,000. And the other account that will be affected is the accounts payable, as we discussed previously. So it will be seen at the liability section. So our liability will go up by 35,000. Next, transaction. Merchandise costing 100,000 was sold on open account for 120,000. So now, we have merchandise costing 100,000 was sold on an open account. So our accounts receivable will go up by 120,000 and our stockholder through the account of income, which is found in the stockholders' equity, by 120,000. So these are the transactions. So the next time we will discuss about how we will use this data to go on to the balance sheet and income statement account. So thank you, goodbye.